European markets post their biggest gain since COVID after Donald Trump's U-turn on higher tariffs less than a day after they came into effect. But there's no relief for China, which now faces import levies of 125%, while Chinese leaders are set to be meeting to discuss more economic stimulus. And the EU says the about turn is good for the economy. It must now decide whether to go ahead with retaliation approved just hours earlier. Plus, coming up on the program, we'll be joined by Carlyle's Jeff Currie as oil hovers near a 4-year low. We'll also be talking to Jean-Claude Trichet about inflation and bonds. Now, first thing is first, let's get straight to all of these markets. I have to say there's a bit of volatility out there. I know we're looking at European stocks opening sharply higher, so we're seeing a lift across the board. But if you look at futures in the U.S., we saw a bit of a reversal, I think, in the last hour or so. I look at Brent crude, always good to look at oil as a benchmark of maybe economic stability. 63.8, WTI down 2.5%. Cross assets. So I'm looking at a couple of things. Not only, did Trump's pivot come as a scale of Treasury sell-off on days of mounting financial stress rattle investors. So we're seeing a little bit maybe on the floor on some of the moves there. But Treasury yields were down about 1 basis point, pairing a bigger drop seen in Asia trading. And then you can see S&P futures. They were actually higher, I think, about an hour or two ago, and now they're down 1.6 and 1.9%. Again, I think after the initial jump, maybe there's a bit more recalibration on what happens after 90 days and what happens more immediately with China. Let's take a look at the European markets map. Again, the CAC 40, 5% higher. All of my producers are extremely excited, and so are we. DAX down some, actually DAX gaining some 5.6%, and the FTSE MIB gaining almost 7%. These are truly extraordinary moves. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, European equities surging this morning, investors celebrating the 90-day reprieve from President Trump's latest tariffs. Now, all sectors firmly in the green, led by the banks and mining stocks. Trump announced a pause in his so-called higher reciprocal tariffs just hours after they came into force, saying he had taken notice of the turmoil in treasuries.
I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. I think everything had. Well, the big move wasn't what I did today. The big move was what I did on Liberation Day.
Okay, so first thing is first, let's check on the markets and some of the individual stocks that are on the move. Joe, we don't do this very often, but actually some of the moves are so extraordinary, we need to really look at industry by industry.
Yeah, that's it. It's justified today, Fran. Absolutely incredible moves across a number of sectors here in Europe today. Take a look at these chip stocks. We actually took quite a while to get these open in European trading. We're seeing ASML up around 6% now, coming down very slightly, but ST Micro up almost 9% as well, Infineon as well. Big moves. Remember, we saw Nvidia up 19% in the US yesterday, Intel as well, so that feeding through into this market this morning. Then also the sector that was catching my eye was airlines, because we saw the US airlines gaining by around 20% in the post-market, and we're seeing moves coming through in IAG, Air France, Lufthansa as well. Now, as I said, there was a lot of volatility coming in. Around half of the stock 600 halted in early trading due to too much volatility. But also keep an eye on the shipping stocks, because if these tariff concerns continue to ease, that potentially means more shipping of goods around the sea, and therefore big moves higher in the likes of AP Moller Maersk over in Copenhagen, and also Hapag-Lloyd in Germany, another sector that I've got my eye on. And banks, of course, have been absolutely slammed by the tariff worries. We've seen huge drops down in these lenders, and seeing that paired today, particularly in Barclays here in London. We're up 13% for Barclays at current trading. UBS coming up 8%. Banco Santander as well with its Mexico exposure. Potentially some relief there, so a big move on that stock. And then just to look at the consumer stocks, because remember, a lot of these companies produce reduce their goods in some of the countries over in Asia, like Vietnam and also Thailand, and therefore they were hit by the tariffs. But a relief, a pause on these tariffs, boosting Adidas, boosting Puma, like we saw with Nike yesterday in late trading, and finally ending on Pandora. Remember, that stock was down around 25% when Trump hit those tariffs because of all their goods, all those charm bracelets made over in Asia. But that one coming up around 10% for Pandora, and a swathe of green stocks this morning, Fran.
Okay, Joe, thanks so much. Joe Easton there from the equities team. Now, joining us now is Virginie Maisonneuve, Global Chief Investment Officer, Equity at Allianz Global Investors, and Tina Fordham, founder of Fordham Global Foresight. I couldn't think of a better team, also matching blues, to try and figure out, first of all, where the tariffs are, where they're not, because it's not as easy. It's not like they're all gone away. We've gone back to the 10%, and I know we've also spoken to tariffs and customs to really try and understand. So we'll get to that in a second, Tina. But first of all, what's going on in the markets? I mean, suddenly it's like there were no tariffs at all.
I think there's definitely a relief part, but clearly we need to have the longer term picture. We need to have the clarity to lift off this uncertainty. So it's relief, probably a lot of shorting going on in the market that were reversed, which explains the sharpness of the reaction, but we certainly need a longer term picture.
Yeah, and if you look at futures in the U.S., they're actually down. So again, there's a bit of uneasiness as we go through the numbers that Tina's gone through.
There is more than a little uneasiness, right? I mean, first of all, I think all of us who remember 2008 and remember 2020 were definitely among those who were queasy, to use Trump's words. Now, the relief rally is obvious. I'm more interested in the collateral damage and the second and third order effects of this tremendous policy uncertainty unleashed by the U.S.
And so if you talk us through the tariff, I mean, again, and we've had to, I think, go to actually Customs and Borders to see how they understand it, because they're the ones checking at the ports, you know, to see exactly what happened. So there's about 10% baseline rate applied to most goods. Yes. And that's, again, according to guidance from U.S. Customs and Border Protection, with the exception of China. So there's still extra tariffs from what there was 2 weeks ago.
Yes, we're still in a weaker position. You know, you could argue that this is where markets thought we would be with Trump, kind of going hard on China and perhaps raising tariffs on other countries. Again, it's the collateral damage from this intervening period and what it does over time to the U.S. negotiating position and other countries' willingness to engage with the U.S., given what appears to be a tactical approach to engaging with partners in the global economy.
And I know you're, a global chief investment officer, equity, but actually the Treasury move is still not really explained why it was so violent, and there must be longer-term implications for all asset classes, Virginie.
Yeah, absolutely. I mean, if you look at the Treasury markets, a lot of the measures are creating potentially less demand from big stakeholders in Treasuries, right? Very clearly. But to me, there's really three dimensions. The first one, of course, is macroeconomic. The second one is impact on earnings. And the third one is the geopolitical game or the shifting world order. And those are just reflected in instruments like the Treasury markets. And I think, we will see continued changes, even if we have a reversal, which, given the size of the movement, I think the way out for Trump is really to come up with a trophy deal. It could be Vietnam, could be Japan, to say, see, I've done that, because he needs to pivot very quickly onto the fiscal, the deregulation, the taxes. Otherwise, within 2-3 weeks, I would say from now, within 2 weeks, the constituents' feedback from the Republican constituents to the House will be very clear, and that's going to create problems. So I think he's got a couple of weeks to really shift.
Virginie, let's also talk about China, because China has repeated its stance that it's open to talks with the U.S., of course, but the dialogue must be based, they say, on mutual respect and conducted on an equal footing. Now, this comes after President Trump ratcheted up tariffs on Beijing to 125%. So let's get the latest from Rebecca Chun-Wilkins. Rebecca, when you look at the China response, I mean, I guess they have two ways. They either retaliate even more, or they step it down and they talk.
Yeah, I think it's a dual-pronged approach. But the other element, of course, for them in the short term is trying to essentially figure out how they're going to manage the immediate impact. Because even if they do find a way to come together and sit down at the table, that is going to take some time to iron out. So we do have this meeting that we're expecting tonight of senior officials. That we expect them to be discussing ways in which to support the economy through consumer spending, through support for the housing market, as well as through technological advancements. Now, some of that is likely to cover what we had already heard of and seen in the NPC, the National People's Congress, earlier this year. We know from that the number one priority is consumption. We're also expecting regulators to meet and try and manage some of the stress and the fallout that we're seeing in financial markets. But to your point, Francine, the big question is really whether or not we see China coming back to the table. You know, the impact on the economy is already being felt clearly in some of the sort of downward estimates that we are seeing from various banks. So Goldman Sachs cutting down its estimate 0.5 percentage point to 4% for this year.
Yeah. Rebecca, thank you so much. As always, terrific briefing. Rebecca Chun-Wilkins in Hong Kong. Tina, there was actually a kind of, bombastic confidence in President Trump that Xi Jinping would come to the table, or his team, despite the fact that they've been defiant so far. I mean, this is not only about the economy. This is about geopolitics and the New World Order. How can we predict what they do next?
And that is exactly why what has been unleashed is so problematic for markets, because it is geopolitics that is driving these policies. Geopolitics is what countries do to project power. No matter what the kind of ex post rationale we try to ascribe to Liberation Day, Trump will claim victory, as you've said, by getting China to the negotiating table. Is it a win for anyone, or is it just unleashing more uncertainty? I'm really inclined toward the latter. It's great if we feel like Trump has saved face and stopped inflicting damage. China plays a longer game.
Yeah. If you look at the last 7 days also, what I thought was very striking is that whether you're an ally like a Modi or even a Netanyahu, it doesn't really make a difference how the White House treats you. So when we look back in the last 7 days, what are the geopolitical consequences of these tariffs?
For me, one of the most extraordinary scenes was the fact that China, Japan, and South Korea came together, arms linked, to talk about a unified response to the tariffs. Now, these are obviously countries with very deep-seated historical animosity between them. That reflex isn't going to go away anytime soon. We also have seen China increase its military exercises around Taiwan. You know, markets were busy looking at other things. And so the forces that have been unleashed, that doesn't go back into the proverbial bottle.
Yeah, and Virginie, again, I mean, we know that China's top leaders are meeting to discuss this extra, economic stimulus in response to the tariffs. So can they support the economy more, and can they actually win as they maybe reinforce their trading relationship with Japan and Europe and others?
Yeah, absolutely. So if you remember, the support for the domestic economy was always in the card, but there was a little bit of power drive waiting to see what the tariffs were going to be. So you've got the two giants sort of talking to each other, not very nicely, but as Tina said, China has a longer-term game. China has its own challenges, demographic challenges, etc., but a lot of dry power. Mm-hmm. I think what is really important is to think, is there room in the world for a WTO ex-US 2.0? Because really, you could have the US play the game of the tariffs, unify the rest of the world, and actually let it be. It's shifting world order. That is what is happening. But for China, we have to remember that one of the strengths of China is its economic power. Currently, 32% of global manufactured goods are made in China, from 5% 30 years ago. So, every 3 out of 4 lithium batteries made in China. Made in China, 30% cheaper than in Europe, 20% cheaper than in the US. So ultimately, we are penalizing the global consumer through that, and the people who elected Trump. So we have to also see what that hidden power is, which should prevail at some point. So I think in the end we'll have a wiser conversation at the table, but the trend for China since the tariffs 1.0 that Trump imposed has been this bifurcation, and that is going to stay.
Virginie, on equities, I want to go back to the point that actually there could be some kind of, WTO rules-based new order without the U.S. But on equities, is now the time to buy? Do you just wait and see because there's going to be a lot more volatility, or where do you see opportunities?
So, at the end of last year, I came up with my 8 points for the year of the snake. One of them was watch margins, anchor portfolio, don't take big bets on the U.S. Everybody was overweight the U.S., be balanced, etc. I think you need optionality in the portfolio because you have days like this. You can't be at 10% cash. Yeah, you might be for a week and it looks good, but ultimately our clients are expecting us to invest. So you want to be able to have those long-term structural growth trends. Tech is absolutely still in there. Why? Tariffs are high increased cost. Companies are going to go and say, okay, how do I mitigate my cost? Of course, it's going to be through technology and AI, particularly now that AI is democratized in terms of cost. So, if you don't have enough tech in your portfolio, look at those weakness days to add to them, but create more of a balanced portfolio for the rest of the year.
I want to ask you about banks as well, because they were slammed because they're exposed so much. But on this idea that actually this new world order, and I've heard chatter, right? It's like, why don't people call Mark Carney maybe in Canada? Can the EU take the lead? Who's the kind of, the counterbalance to the U.S. that's not China right now?
Well, this is the Kissinger idea, right? Who do I call? I'm not sure it's going to be Mark Carney or any one leader. I'm often asked by our U.S. clients, who in Europe is going to be in charge. What I think is a more practical way of thinking about this, relating to Virginie's point, is there a subset of large economies that are going to continue to follow the rules-based system? And yes, there is. And that also includes big countries like India. It's not only, the G7 ex-US. But I think this is part of the collateral damage that I was talking about that I don't think Washington fully appreciates at this stage.
And Virginie, I want to talk to you about the banks, but I guess a broader point, we're seeing quite a big correction or, going back to levels that were maybe more in line with what we were expecting for Donald Trump. Do you still expect quite a lot of volatility? Because these tariffs are moving around, and it takes time to see where the loans are, where the things that are going sour along. So it's not as easy as saying, right, we're over this.
Yeah, absolutely. So for the sector, the banking sector in particular, clearly the environment and the macro environment, remember we talk macro geopolitics and earnings, that is absolutely critical. What our companies are paralyzed right now. Do they invest? Do they do M&A? So you have to be very careful. Look at the cost of capital for those banks. And do you think they're going to be able to exceed in, make more money than their cost of capital? That's the key. Some will not. But if you look at the rest, at the market overall, it's going back to margins. There's going to be a sharing of the cost of those tariffs. Is it 50-50? Where's the power of demand? Is there demand elasticity or not? Because that will be where the shift of the cost burden will take place. So I think, within the financial sector, you have other companies that are interesting. In the banking sector, you want to be very mindful about that cost of capital element.
So interesting. I could talk to you for another 2 hours, but there's unfortunately other news we need to talk about. Tina Fordham, founder of Fordham Global Foresight, and Virginie Maisonneuve, Global Chief Investment Officer, Equity at Allianz Global Investors. Coming up, European equities surged the most in 5 years after Donald Trump's U-turn on higher tariffs. So we'll take stock on where we are in terms of global trade. That's next, and this is Bloomberg.
People were jumping a little bit out of line. They were getting yippy, They were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president. I know the presidents. They wouldn't have done it.
President Trump there on why he backed down from higher tariffs less than a day they came into effect. Now let's take stock of where we are after Donald Trump's U-turn on higher tariffs. We're joined by Bloomberg's Charlie Wells and Brendan Murray, our trade SAR. So, Brendan, I mean, I like the way, the president put it. It's a bit yippy. I mean, they were all over the place, frankly. The markets were really scared, and there was, talk about distress. But I went through, I tried to do through all of your team's great reporting, where we are on tariffs. I mean, there's still 10%. So we're back. It's not that they got rid of the tariffs, is we're back to where markets were expecting Donald Trump to land this last week.
Yeah, I think we've gone from what was basically a global shock to the system to something more of a slow burn on the U.S. economy and the economies affected by the tariffs. In particular, the move yesterday to sort of take a U-turn on all the other reciprocal tariffs allows the administration to focus on its main goal, and that's trying to rein in China. Those 125% tariffs that the president raised yesterday, they were met this morning with tough rhetoric from Beijing as well, saying we're going to fight this to the end. So I think what this does is focuses the attention now on the real prize, and that's trying to rein China in for the Trump administration.
Yeah, and this is 100% what we're watching for. And then we also heard from Donald Trump that he may be a little bit easier on companies that are really get hit. And Charlie, that's what you're focusing on today, is trying to figure out the companies that will be slammed compared to the ones that will be maybe okay-ish.
Yeah, we're looking at the corporate reaction. And, Bloomberg Economics has this number out that kind of speaks to your point about how the tariffs are still there, right? So they have the U.S. average tariff rate. It's gone down from 27% to 24%. So that's still significant. And something else that Trump talked about yesterday that is kind of getting lost in a lot of this market euphoria right now is that he still intends to bring in these sectoral tariffs, right? He literally talked yesterday about how the pharmaceutical tariffs are coming. He wants to bring pharmaceutical companies back to the U.S., and that is a warning that European pharmaceuticals issued earlier this week.
Brendan, I mean, I know we've been reporting, and I love that your team actually went to speak to a U.S. Customs and Border, officer, because these are the people at the ports that then have to fill out everything to know how much they're taxing staff. I mean, is it chaos a bit?
Yeah, I think it's paralyzing, is what it is. Companies don't know whether to order more from a different country or just stop ordering and hope that this blows over. So the dark clouds that were over markets and the global economy yesterday aren't completely gone. There's still a cloud of uncertainty, and it looks like it's going to be protracted through the summer, through the next 3 months or 4 months, where global trade basically won't grow, and it could even go in reverse. The WTO's latest forecast is for a minus 1% contraction in global growth in global trade this year. So that's not a good thing if you're doing business in China, you're doing business in Europe. It's a headwind for everybody.
So, Charlie, you're an Amazon, you're a Walmart, you're even a Kohl. Like, how do you deal with this?
Yeah, I mean, Bloomberg has done some excellent reporting, really showing kind of the specifics of how this could play out. And if we want to look at Christmas ornaments, I think they tell a great story. Always a great story. They tell a story about how executives have to focus beyond 90 days. So great, we've got a 90-day reprieve. What about that? Walmart has told a factory in China that they need to stop putting price stickers on Christmas ornaments because there's still so much uncertainty about what those prices could be. We know that Amazon has been canceling orders, and also the likes of Kohl's, which is the clothing retailer in the United States. They put in orders recently and then had to tell Chinese factories to stop those orders, even though raw materials had already been procured.
And are we expecting in the next couple of days to understand more what China wants to do? I mean, Donald Trump was pretty confident yesterday that they'll come to the table.
Yeah, that's not the way China operates, or at least that's what our analysts tell us, is that China does not negotiate with arm twisting and the kind of approach that Donald Trump is taking. So we'll have to see how Beijing responds. You would imagine that there's a lot of back channeling going on right now to bring these two sides. The tariffs won't help either economy, but certainly China has a toolkit of retaliation measures that it can dig into, and it could do everything from control the amount of raw materials, critical minerals that are shipped to the U.S. To targeting targeting specific U.S. companies, big tech companies. Tesla has a big factory in China. So, those kinds of things, that China still has in its back pocket that we haven't seen yet.
Brendan, I mean, do we need to really start thinking about some of the permanent damage that this has done despite the turnaround?
Yeah, I think the Trump administration tried to undo a lot of that yesterday, the sort of chaotic rollout of reciprocal tariffs, one number for everybody. That's out of the picture now, at least for the next 3 months. But there still remains a 10% tariff on all U.S. imports from everybody, and 125% on China. That will, if it stays in effect and they don't get to the negotiating table, that will decouple, one of the largest trading relationships in the world, with about $700 billion worth of goods moving back and forth between the two countries.
Great. Thank you both for joining us, Charlie Wells and Brendan Murray. Now, coming up, we look at it from, of course, an ECB perspective or central bank perspective. We'll get the view of Jean-Claude Trichet. He's the former ECB president. And one of the questions we'll be asking is exactly that. Is there any permanent damage to either inflation expectations or just the economy going forward? This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European markets post their biggest gain since COVID after Donald Trump's U-turn on higher tariffs less than a day after they came into effect. Well, there's no relief from China, which now faces import levies of 125%. Well, Chinese leaders are said to be meeting to discuss more economic stimulus. And the EU says the about turn is good for the economy and must now decide whether to go ahead with the retaliation approved just hours earlier. Plus, coming up a little bit later in the program, we'll also be joined by Carlyle's Jeff Currie as oil hovers near a 4-year low. Now, before that, let's get the latest from Brussels, and the European Union's digital chief, Henna Virkunen, says the bloc's rules governing digital platforms should not be considered barriers to trade with the U.S. Now, the bloc has opened a number of ongoing probes into the behavior of U.S. online platforms, including X. But the EU says it does not want a trade war with Washington.
We are going to continue the negotiations because it has been all the time the message from the European Union side that we want to negotiate, and we don't want to have tariffs and we don't want to have trade war because we don't see that anyone is benefiting from that. And of course, it's very important for businesses and industries to have legal certainty and also stability.
Well, for more, let's get straight to Bloomberg's Oliver Crook, who interviewed her earlier, of course, this morning. So, Oliver, I mean, there does seem to be a direct link with, some of the digital kind of people going after big giants and a possible retaliation on trade.
Absolutely, Francine. And that's a distinction that Henna Virkunen there wanted to make, that is saying that basically these are two separate, completely separate issues, tariffs and tech. These are issues that do not touch one another. We know from the Trump administration, however, that they don't really necessarily draw that kind of distinction. One of the main gripes that the Trump administration has had, whether it's Donald Trump, Howard Lutnick, or Scott Bessent, is this idea of non-monetary barriers, non-tariff barriers to trade. And one of those is tech regulation. And until we basically got that reprieve yesterday from the Trump administration, that 90-day hold on those so-called reciprocal tariffs, dropping it from 20% for the EU to 10%, the EU was next week going to develop a new architecture to basically be able to hit back at the United States, not just on tariffs, but potentially also targeting technology companies. I asked her if during those conversations she had been a part of them in developing that architecture. She said that basically the only line that we have here, the only thing that we're going to say is that we want to have a good and productive relationship with the United States. But for the EU, if this trade discussion re-escalates, these tariffs come back in the end of 90 days, one of their greatest point of leverage is against American tech companies. So watch that space if indeed this has to re-escalate once more.
Ollie, this comes as the EU has also approved retaliation for Trump's earlier tariffs. So take us through exactly what tariffs are in place and what is not.
Yeah, Francine. Yeah, Francine. I mean, it's Thursday, so it's perfectly normal these sort of days that we have our third sort of global tariff regime of the week. So we had those 20%. We've now come down to 10% in terms of the minimum tariff. But we should say, Francine, that despite the fact that this is a big reprieve, this is a reprieve that has sent the market skyrocketing, this is still an enormous trade barrier between the biggest trading relationship in the entire world, between the United States and Europe. We're talking about 10% tariff on the 500 billion euros worth of goods that go over to the United States every single year. And we should also say you still have those 25% tariffs on the auto sector, a major sector for the European economy. Steel and aluminum, 25%, that is still there. And just on hold is that only sort of extra 10% to the minimum tariff. So these are still the conversations that are going to be before the policymakers here in Europe. This is sort of the Trump technique, where you sort of end on a sweet note, despite the fact that you have a sort of very bitter pill that you had to swallow. And for finance ministers that are gathering tomorrow in Poland, the question is, A, what is the impact still going to be on the economy? It's still going to be absolutely vast. And B, can you really trust the United States if they're willing to use this point of leverage at every single point of the way? What is going to prevent them from bringing it back to the fore if they get exactly what they want? And that's a discussion we're going to have with the German finance minister, the Irish finance minister, and a number of different guests tomorrow in Poland.
Oliver, thanks so much. Charlie Quick there in Brussels. Now, European Central Bank Governing Council member François Villeroy de Galhau sees U.S. President Donald Trump's decision to pause on higher reciprocal tariffs as a step forward, quote, economic reason. Now, de Galhau believes that protectionism is bad policy that will negatively impact the U.S. economy. He added that the EU's cool heads and unity in its reaction to the U.S. will not lead to an increase in inflation in Europe. Now, for more on all of this, we're joined by the former European Central Bank President, Jean-Claude Trichet. Monsieur Trichet, as always, thank you so much for joining us. Look, do you think, Monsieur Trichet, that there's any permanent damage from what we saw over the last 7 days, despite the turnaround from Donald Trump? Is there any lingering sense of unpredictability in U.S. policy that will impact also monetary policy?
Hello, Francis. Thank you for inviting me. Yes, indeed. I think that there are permanent scars after what has happened. By the way, the start of the drama was decided upon by the big executive branch, which is the U.S. presidency. And I have never witnessed over all my period of time, all my professional career, such a drama which would be triggered by any executive branch. So it seems to me that what we have observed is incredible in terms of, I would say, unpredictability of what could happen. And of course, the U-turn, but I'm not sure that it is a U-turn, it's a pause. And the pause is welcome, only triggered, by the way, by the reaction of the markets, the catastrophic reaction of the markets all over the world, and particularly, of course, in the US. So we are still in a universe of unpredictability, which is extremely damaging, both, I would say, for inflation, for growth, and for the overall reaction of all partners. So I hope very much that we will go back to trust and credibility of the various partners in question. But that's, if I may, a hope. It's not what we are observing right now.
Monsieur Trichet, I mean, so many market participants yesterday, frankly, were so shocked by, almost the distress in the markets. Do you think that we were close to a global financial crisis to the scale of what we saw during Lehman?
I don't exclude that, obviously. Particularly if the idea of escalating the conversation would have been the rule of the game, which seemed at the very beginning to be more or less the attitude of the U.S. president. So I think it looks a little bit like the reaction of all of us, by the way, when we had Lehman. You might remember immediately after Lehman, the rhetoric of the U.S. Treasury was, after all, we are not in Soviet Union, we are in a market economy. When a particular entity, namely Lehman Brothers, collapses, it's normal. You behaved improperly, you manage very, very poorly, then there is a bankruptcy. This rhetoric lasted 2 days and a half. I was the witness of that, of course, in permanent conversation with the U.S. friends. After 2 days and a half, the idea was I would say, house of cards is collapsing. We have to do something. And the reaction of the executive branch to save the day was extremely determined. But the overall, if I may, political sphere in the US was not necessarily on board, and they first refused the program which was presented by the Treasury only when the Dow Jones collapsed. The political sphere in the US understood that it was very serious. And then in the present case, we had 7 days for the executive branch to realize that, as a matter of fact, there was a house of cards collapsing. So I'm happy, of course, by the pause, but again, it's not yet, I would say, very, very convincing in terms of the future after the 3 months.
But, Monsieur Trichet, I mean, this is exactly what I wanted to ask you about. You were president of the European Central Bank in 2007, where there was this agreement also on, swap arrangement between the Fed and the ECB. Do you think that the two could come together today if there was more distress in the markets, let's say in 3 months, we don't know what happens next, to do the same like back then, or has the political landscape really changed?
Well, we will see. I have a full trust in the central banker. They proved on both sides of the Atlantic and everywhere in the world that they were highly responsible, highly able to cope with the surge of inflation that we had to cope with. So I maintain my full confidence in the ECB, in the president of the Christine and François and all the other central bankers of Europe. I know that they will do what is the best in the circumstances. I have also a lot of respect for Jay Powell. It seems to me that in the circumstances he behaved extraordinarily properly. We will see what happens, of course, in case we had a deterioration of the situation. I remain a little bit optimistic because clearly it seems to me that the executive branch in the US understood that you cannot do anything. You have to be responsible.
With so much market turmoil, though, where should regulators be looking for risk right now?
Well, again, I expect that we will have some calming down. So the main problem are the scars in terms of inflation expectations and in terms of real growth in the US and in the rest of the world. Even now, with the 10% increase of tariffs, we have an impact in terms of growth and in terms of inflation expectation, which is not negligible, of course. We are happy that the worst seems to be over for 90 days, but it is not a very good situation at all. And I expect, again, all the central banks to do the best in the circumstances, as I already said, even if it is quite complicated.
Monsieur Trichet, if you can hear me, I think we're just trying to put the earpiece back, so you should be able to hear me now. Monsieur Trichet, for Europe specifically,
yes, I am.
It's very clear that traders, fabulous, you can hear me, traders are paring bets on the ECB interest rate cut. How vulnerable is Europe still to industry shifts, for example, like cars, and exposure to China?
Again, the uncertainty is unfortunately, by the way, the decision, if I may, of the executive branch in the US, very profoundly in the picture. So uncertainty being the rule of the game, you have to prepare for anything. We will see what the ECB will decide, both, I would say, in terms of monetary policy and the decision that is very likely to be taken in terms of decrease of rates. The markets were projecting an interest rate decrease. The present situation will not guide me to say, no, they will wait to see exactly what inflation is doing and so forth. It seems to me that the overall situation does not call for a change in the present expectation. The rest of it depends extremely importantly on what is likely to happen in the US, frankly speaking. The US is the, I would say, place where the drama is played. And so we will see. I have no other I would say, message than at this moment confidence in both central banks and the central banks the world over.
Yeah. Understood. I mean, longer term is the era of dollar dominance, and with that comes exorbitant privilege, actually, for the U.S. Is that over? Are there any longer term implications that the euro could strengthen its international role?
Yeah, you're very right to ask the question, of course. What is strange with the U.S. attitude, at least in the last weeks or month, is first the fact that the U.S. attacked friends and allies exactly as they were seemed to attack the enemies. So it's very, very strange. And of course, it's an immense disappointment for the European and for allies in general to see this behavior. And the scars are considerable. As regards the dollar, it looks the same. The dollar is, of course, a very important currency the world over, having a position in the overall currency situation of, say, 60%. All the indicators are giving the dollar 60% of the overall global position, when we have 20% with the euro. To play against the dollar seems strange, and I have not witnessed such an attitude from the U.S. executive branch. I don't expect that it will last, but one never knows. And of course, as everybody knows, the euro is a credible, a solid currency which keeps its value over time and is a full success. So we will see what happens.
Thank you so much, as always, the former European Central Bank President there, Jean-Claude Trichet, with all of the insights and, of course, a history of what we've lived through in the last 20 years. Now, coming up, Jeff Currie from Carlyle on his outlook for the energy and commodities markets. This is Bloomberg. The conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, oil extending its volatile run as investors grapple with President Trump about face on his signature trade policy. Now, this comes as the U.S.-China trade war and OPEC's plus decision to loosen output curbs weighs on oil prices. Well, we're now joined by Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. Jeff, I'm just so happy to speak to you because actually it's been crazy. Like, there's been distress, the markets roll over the place. Like, what have we lived through in the last 7 days?
Liquidation now, ask questions later. And I think that's the reason why correlations have broken down. But, you know, yesterday the markets hit a bottom and they came back up. And when we look at oil in specific and commodities market generally, the dead cat bounce was really a dead cat bounce. It was relatively small, which I think is telling you a lot, that there's still a lot of risks left in the system. And when we look at the overall tariffs, they're the highest in a century. They're still at 25%. And then second, when we look at who got hit the hardest, it's the superpower of manufacturing. And then the other thing to keep in mind, and this goes to oil and commodities, U.S. is the largest exporter in the world and producer of oil. China is the largest importer of oil. So oil and commodities are in the crosshairs right here, right now. And, you know, when we look at China, I want to emphasize in the United States how they fit together. Yep. The United States is a barbell economy. It's got tech on one end, commodity production on the other. What sits in between? Everything China has. And so when we think about where this trade war currently exists, everybody, you know, viewed as reprieve because everybody else got a 10% and China goes elevated to 125%. China is the critical component here relative to where the U.S. sits. So I think oil probably has this right in repricing the risk again this morning.
But do you think, are we headed towards a severe recession in the U.S., but even globally, even with where we are now, this like 3-month reprieve, or could we at least be headed to like 2008 crisis style?
Well, I think, you know, the situation is radically different because it begins with policy. The policy put is kind of, you know, benign, to say to be kind here. And I think that the risks here are very different than anything that we've ever seen. I think what happened yesterday was a liquidity issue. And you could see it in gold. Gold sold off. When you're in a crisis and gold is selling off, that's telling you got a liquidity problem. And then, boom, they came out with the reprieve. Gold bounced back up, which is telling you that, hey, liquidity came back into the system. So I think, that the environment we're dealing with is not like 08 and those other environments because it's policy driven.
Okay, but will this kill, for example, U.S. shale?
I think that's the biggest risk here. What is the U.S. biggest dog in the fight? It is the oil. In fact, I like to point out, what are the 3 Bs of U.S. exports? Bushels, barrels, and bombs. Those are the big 3. And the biggest one of them all is the barrels. It's $350 billion of exports. And here's the critical point. As you ask the question, shale is highly supply elastic. And so when we look at what the U.S. exports, bushels and barrels, they're fungible. China can get them from Brazil. They can get the oil from OPEC. The problem with the U.S., all the stuff that China exports is non-fungible, which means they can't go other places to get it, which means the U.S. consumer is going to feel more of this than what the Chinese consumer feels.
So your base case is what, that the U.S. president realizes and then does a U-turn like he did yesterday also on China, or how does this end?
I think how it ends is who's going to feel the most pain here. As you ask, shale, we get below 55, which we were last year. Even the Permian shuts down. Below 65, you're shutting down other parts of the shale patch. The other one that's getting hit hard are farmers, the bushels. So when we think about, which are the congressmen to break ranks or the lawmakers to break ranks in the Republican Party, they're from states that have farmers and oilmen. In fact, who is it? It's Nebraska, it's Iowa, it's Texas that are now beginning to break ranks. And so you ask you, where is it going? The people that are going to feel the most pain are these commodity producers.
But so are you expecting, so first of all, how quickly could we go to those levels? And are senators and governors going to start going to the White House and saying, hey, hold on, this is a massive mistake, I'm going to lose my constituents?
I think we got there yesterday. You were at $56 a barrel in WTI. We're down at that point where you're now digging into the cost curve. And let's not remember the decline rates on U.S. shale are massive. It'll just drop off a cliff as you begin to cut expenditures. And these cycles are rather quick. I like to point out the United States in 2020 through 2021, from April 21, oil prices went negative. It shifted in being a net importer. This could increase the current account deficit because they lose their biggest dog in the fight. And by the way, you get the wheat prices when they're an exporter. And by the time they swing to being a net importer, you were back to $100 a barrel.
But Jeff, this spells disaster.
We look at the commodity markets. They are the most supply elastic. It goes back to my point. You got to recognize China has non-fungible goods it's exporting. United States' biggest dog in the fight are fungible commodities that are very supply elastic.
But Jeff, if you're China, you just play the long game, right? You try and support the economy and wait this out.
That's, you look at what you learned in 2020 and 2021 during the pandemic, that production came off really fast. Which means that the drop in production could impact the current account deficit in a negative way. Because, again, what was the biggest driver of the current account deficit over the last 50 years? It's oil.
Where does all of this turmoil leave the energy transition?
When we look at it, improves the energy transition. I like to point out a security-driven energy transition is faster, more profitable, and cleaner. Proof in the pudding. The energy transition started in 1973 with the first oil crisis. From 1973 to 1993, we saw massive investment in nuclear power, renewables, and the rest of it. It dropped fossil fuels from 94% of overall demand down to 85%. The net zero 2050 transition took you from 85 to 81, and it was expensive and it was difficult. So when people are scared and energy security is a priority, they act quick. And I like to point out, you need to have energy security over affordability over the environment, and you'll get there.
But even in the U.S.? So this is like an unintended consequences of what this trade war looks like.
Yeah, I'd like to point out, France has the lowest carbon emission footprint in the world because of its nuclear power. It didn't get there because it wanted to save the climate. It got there because of energy security issues. So there is a silver lining in the cloud here, per se, but energy security is typically a much faster and quicker driver of a transition.
Jeff, is there any way that the U.S. at this point can avoid a recession?
I'm not the macroeconomist, and when I get in there, but I would argue that in energy, the shale patch is going to go through a really difficult time here. You're already feeling it. And let's not remember, when we think about oil prices, I know that the administration targets 50 to 55, which is below the Permian break-even. It's going to cause problems. The United States is the world's largest oil producer and the world's largest oil exporter. Really low prices are a bad thing for the United States. And you saw this in 2015, and you saw it in 2020. But let's look at 15 because it was different. Yes, it benefited Chicago when the oil prices came off in the northern states. But by the time the CapEx came off in 2015 and 2016, it was detrimental to the U.S. economy because that's a lot of CapEx and jobs that would be lost from the energy sector.
Jeff, given all of this, has OPEC Plus made a terrible mistake? Will it fall apart?
Yeah, I think their 400,000 barrel per day increase last week was a shot across the bow to the rest of OPEC members as well. Do not cheat. Now, the problem with that explanation was the following morning on Friday, Russia came out and backtracked on shutting down the CPC pipeline. So somewhere there was probably some pressure on Russia somewhere there. But I think the key point there is, when we look at the situation right now, there's a lot of downside risk here. And you and I have been doing this for a while. We know that this oil market, it doesn't do three-point landings on 50 to 55. Odds are it's going to overshoot to the downside.
Jeff, as always, thank you so much for joining us. Jeff Currie, there, Chief Strategy Officer at Energy Pathways at Carlyle, after a pretty eventful week. Very diplomatically put. Tomorrow, stand by for an interview with Ray Dalio, the founder of Bridgewater Associates. We'll also get his take on the higher tariff pause, what it means longer term, and dollar dynamics. Up next, a Bloomberg Brief, and this is Bloomberg.